Chip stocks just raised almost an entire crash in 5 trading days. Tesla and Alphabet are about to report earnings that could decide where this whole market goes next. And oil prices are spiking for a reason that has nothing to do with the stocks you are watching and everything to do with them. So, if you only watch one market video this week, make it this one because I am connecting all three of these stories into one picture because they are not separate, they are the same story from three different angles. I'm Bilal, and every week I break down what's actually moving markets without the noise, without the hype, and without pretending I have a crystal ball. Let's get into it. Before we start, if you find this useful, subscribing generally helps me keep making these breakdowns, so consider it now. Let's dig in. The AI trade is back. Let's start with the story that's dominating trading desks this week: semiconductor stocks. Last week, the Philadelphia Semiconductor Index, the SOX, which tracks the biggest chip companies, fell into what's called a bear market. That means it dropped more than 20% from its recent peak. That's a big deal. Bear markets in a specific sector usually mean investors are seriously questioning the story behind the sector, and the story behind chip stocks for the last 2 years has been one word: AI. Every company, from Nvidia to AMD to the memory chip makers, has been riding the idea that AI infrastructure spending, data centers, GPUs, high bandwidth memory, it's basically a bottomless well of demand. When that story cracked last week, chip stocks got hit hard. But this week, something shifted. The SOX bounced back sharply. Asian chip stocks led the charge. Samsung Electronics and SK Hynix, two of the biggest memory chip makers in the world, jumped significantly, and South Korea's Kospi Index, which is basically a barometer for global AI investment sentiment, had its biggest one-day gain in a month. Kospi plus 4.6% in one day. So, what changed investor sentiment so fast? A few things come together. First, NVIDIA revealed a new stake in a company called Nebius. Nebius is an AI infrastructure and cloud computing company. When NVIDIA, the most important company in the entire AI supply chain, puts fresh capital into more AI infrastructure, that's a signal to the whole market. We still believe demand is real. That single move helped calm fears that AI spending was about to slow down. Second, there has been renewed optimism around the potential de-escalation in Middle East tensions, which took some fear premium out of markets broadly, giving risk assets like chip stocks room to run. Third, and this is important, the initial 20% drop was not really about AI demand collapsing. A lot of it was leveraged bets and winding. When a sector runs up hard on borrowed money and then that borrowed money gets pulled fast, you get an outsized crash that looks worse than the actual underlying business fundamentals. The unwind finishing is part of why we are seeing such a sharp bounce back. Now, here is the nuance I want you to actually walk away with, because most content online will just tell you chip stocks are back, buy the dip, or chip stocks are doomed, and both of these takes are lazy. The real takeaway is this: the AI trade is not dead, but it's more fragile than it looked 6 months ago. A 20% bear market swing in 5 days tells you this sector can move violently in both directions based on sentiment, not just fundamentals. That means position sizing and risk management matter more than in a boring sector. If you are holding semiconductor exposure, understand that volatility is now part of the deal, not an anomaly. And this AI story does not exist in isolation. It's about the collide directly with tonight's big tech earnings, which brings us to segment 2: Tesla and Alphabet earnings. What actually matters? Tonight, after the market closes, two of the most important companies in the world report earnings: Tesla and Alphabet, Google's parent company. This matters way beyond just those two stocks, and here is why. This morning, Before these earnings even dropped, futures on the Nasdaq were already sliding. The Dow and S&P futures dipped too. Investors are nervous heading into this print, and that nervousness itself is a signal. It tells you the market thinks there is a real risk that these results disappoint relatives to sky high expectations. Let's break down each by one, because what actually matters is not what most headlines will tell you. Alphabet. The stock actually dropped in early trading today, even before earnings, likely on profit taking and caution ahead of the profit. When Alphabet reports, the headline revenue and profit numbers will get all the attention. But here is what professional investors actually watch: cloud revenue growth and AI infrastructure spending guidance. Google Cloud is now a major growth engine, and how much Alphabet says it plans to spend on AI data centers going forward tells you more about the next 12 months than this quarter profit number does. If spending guidance comes in way higher than expected, that can actually spook investors, because it means that the AI arms race Alphabet is fighting requires still more capital, squeezing near term margins for future growth. Tesla. With Tesla, the mistake almost everyone makes is watching the immediate after hours price reaction and treating it like the final verdict. Don't do that. After hours training has thin volume. A small number of trades can swing the price widely, and that move frequently reverses by the next morning once full volume trading resumes. What actually matters for Tesla is delivery numbers, gross margins on vehicle, and any commentary on the timeline for newer initiatives like robotaxi or energy storage margins specifically, because Tesla has been cutting prices to defend market share, and the market wants to know if that's stabilizing or still eating into profitability. Okay, what actually moves the stock long term? Here is the bigger picture connecting this to segment 1. These earnings are happening in the middle of that fragile AI sentiment rebound we just talked about. If either Tesla or Alphabet delivers a disappointing outlook, especially around AI spending or capital expenditures, that could be the exact trigger what reverses this week's chip stock. Really, markets are jumpy right now, and a bad print from a bellwether like Alphabet does not just hit Alphabet stock, it hits sentiment across the entire tech sector. On the flip side, if both come in strong, especially with confident AI spending guidance, that reinforces the AI trade is back narrative and could extend this week's rally further. This is exactly why I said at the start of this video, these three stories are not separate. The chip stock rally, tonight's earnings, and the market sentiments are one connected chain reaction, and tonight is a genuine hinge point for the week. My honest take: don't make any large portfolio decisions purely based on the after hours reaction tonight. Wait for the conference calls. Wait for analyst reactions the next morning, and watch how the broader market not just these two stocks responds over the following two trading sessions. And the segment 3 is oil prices, Iran, and the inflation problem. Now let's zoom out from tech stocks completely, because there is a second major story this week that most stock markets content is undercovering. Oil prices are climbing, and it's connected to everything we just discussed. Here is what's happening. Peace talks aimed at de escalating tensions between the US and Iran appear to have stalled, and there have been fresh US strikes reported as part of the ongoing conflict. Markets hate uncertainty, and geopolitical uncertainty around a major oil producing region is one of the fastest ways to push oil's prices higher, because traders start pricing in the risk of supply disruption, particularly around shipping routes like the Red Sea. Now, why should someone watching a stock market channel care about oil prices because oil is not just an energy story, it's an inflation story. And inflation is the single biggest lever affecting Federal Reserve policy right now. Let me walk you through the chain reaction because this is the part that ties the entire video together. Step 1. Rising oil prices increase cost across the economy, transportation, manufacturing, shipping, basically everything gets more expensive to produce and move. Step 2. Those rising costs tend to show up in inflation data with a lag of a few weeks of a couple of months. Step 3. If inflation data starts ticking back up because of oil, that makes it harder for the Federal Reserve to justify cutting interest rates. Or it could even revive discussion of holding rates higher for longer. Step 4, and this is the part that connects directly back to segments 1 and 2. Higher for longer interest rates are historically bad news for high growth stocks, especially tech and AI related names, because their valuations are built on discounting future earnings. When rates stay elevated, those future earnings get discounted more heavily, and stock prices for growth companies tend to compress. So, here is the tug of war happening in markets right now. In plain terms, on one side, you have got a fragile but real AI stock rally trying to reassert itself. On the other side, you have got rising oil prices, creating inflation risk that could force the Fed to stay restrictive, which works directly against that some or same AI stock rally. That is exactly why markets have felt so choppy and headline driven lately. You have got two powerful opposing forces fighting for control of investor sentiment in the same week. Pushing stocks up, AI rally, Nvidia's stake, strong earnings, hopes versus pushing stocks down, oil spike, inflation risk, Iran tensions, and cautious effect. Well, watch oil prices over the next 1 to 2 weeks more closely than you would normally think. It's currently one of the most underrated indicators for where broader market sentiment goes next, precisely because of this inflation to Fed to growth, stocks pipeline, and segment 4. What this actually means for your portfolio. I want to be upfront. I'm not a licensed financial advisor, and nothing in this video is personalized investment advice. This is education and analysis so you can make your own informed decisions. With that said, here is how I would think through this week's setup if I were mapping out my own approach. First, recognize that volatility is the theme right now, not directions. We have got a market that can really hard on one earnings call and give it all back on the next inflation print. In that kind of environment, position sizing matters more than stock picking genius. Don't put yourself in a position where one bad week wrecks your plan. Second, pay attention to the difference between a stock's price reaction and the actual substance behind the earnings report. We covered this with Tesla and Alphabet. The after hours price swing is noise, the actual guidance on spending, margins, and growth is signal. Get in the habit of reading past the headline numbers. Third, understand sector correlation right now. Semiconductor stocks, AI infrastructure names, and mega cap tech are all more correlated with each other right now than usual because they are all trading on the same is the AI trade real narrative. That means if you hold several of these together, you may have less diversification than you think. A bad print in one can drag sentiment across all of them. Fourth, keep an eye on macro data alongside your stock picks. Oil prices, inflation prints, and Fed commentary are not separate from your portfolio even if you don't hold energy stocks. They influence the interest rate environment that every growth stock is priced against. And finally, This is the mindset point I care about most. Don't let any single day's headline dictate a big decision. This week alone, we have seen a chip stock crash, a chip stock rally, pre earnings jitters, and an oil spike, all within about 7 trading days. If your strategy can get whipsawed by that kind of noise, the strategy needs work, not the market. What to watch this week? Quickly, here is what I am personally watching for the rest of this week. The market reaction to Tesla and Alphabet's earning calls, not just tonight's after hours moves, but how analysts revise their price targets over the next 48 hours. More big techs earning rolling in over the coming days. This is peak earning session, and each report either reinforces or undercuts the AI really narrative. Any headlines on US Iran negotiations, a genuine de escalations could ease oil prices fast, while further escalation could push them higher and add more inflation pressure. And any Fed commentary, remember, oil driven inflation risk is now directly in play for how the Fed talks about future rate decisions. I will be covering all of these in shorts throughout the week and in next week's full breakdown. So make sure you are subscribed and have notifications on if you want to update as they happen. So to bring it all together, chip stocks are dragging on real but fragile comeback. Tonight's Tesla and Alphabet earnings could be the hinge point that decides whether that comeback continues or rising oil prices from Middle East tensions are quietly building inflation pressure that could work against the entire rally if it continues. Three stories, one connected picture, and now you understand it better than most people scrolling headlines today. If this breakdown helped you actually understand what's happening instead of just reacting to headlines, that is that is exactly what this channel is for. Subscribe if you want these breakdowns every week. Drop a comment with what you want me to cover next, and I will see you in the next one. Thank you.